Stop lying to yourself. Your portfolio isn't just underperforming, it's quietly draining your confidence. And it's time to fix it. Welcome to the program You Can Surpass the Stock Market. Here I show you how you can reach the peak where few arrive in the stock market without getting overwhelmed. I am Francisco, and I am an expert in finding stocks that can top the S&P 500. Today, we're talking about a topic that's rarely addressed with honesty: how to deal with the frustration of low stock returns. Before we dive deep, let's understand what this means and what it doesn't mean. But what dealing with the frustration of low stock returns really is. It's about acknowledging that your investment performance isn't matching your expectations, feeling that internal tension and disappointment, and then using specific psychological and practical methods to process these emotions, regain clarity, and improve your decision making going forward. It's not about magically flipping a switch and suddenly beating the S&P 500 overnight. Instead, it's about accepting where you are at, leveraging mental strategies to handle the disappointment, and applying practical steps to enhance your approach to the markets. What dealing with the frustration of low stock returns is not. It's not about surrendering to fear or shame. It's also not about just toughening up and ignoring the feelings completely. We're not going to pretend that frustration is simply weakness or that acknowledging psychological factors makes you less of a safe investor. It's not about wishful thinking or secretly hoping to become a millionaire next week by trying random internet stock tips. Instead, it's grounded in the reality of improving your mindset and processes so you can gradually enhance your returns and potentially surpass market benchmarks over time. You might be wondering, why focus on the psychological and practical strategies to deal with the frustration of low stock returns at all? Why is this even worth your time and mental energy? Think about it. The markets are challenging even for the most seasoned investors. If you fell stuck and yet struggles to outpace the S&P 500, this is a pain point that's more common than you think. Many people face a scenario where they're putting money into the stock market hoping to beat the average, only to find themselves lagging behind the benchmark. They might check their portfolio once every few days or weeks, see the red numbers, feel that tightness in their chest, and then tell themselves, I'll just work harder at my job, I guess, or I'll try something else next time. But that frustration accumulates over time, and it starts to erode confidence, spark bad decision making, and push investors into emotional trading, selling at the worst times or chasing hot tips that don't pan out. And what are these psychological and practical strategies? They're a set of mental frameworks and actionable steps that help you acknowledge your frustration, process it in a healthy way, and then change your energy into constructive improvements. Psychologically, this might include reframing your expectations, building emotional resilience, or understanding how biases impact your decisions. Practically, it might involve adjusting your asset allocation, adopting systematic investment habits, or refining your research process. These strategies are rooted in both self awareness and tangible action. It busts that lingering sense of disappointment, anxiety, and confusion you face every time your portfolio underperforms. It tackles the frustration that comes from feeling you should be doing better and that maybe you're not cut out for this. Most importantly, it addresses the internal struggle, the emotional pain of feeling left behind while the market marches upward, or worse, feeling powerless and incapable of catching up. When you handle your frustration properly, you free up mental space. Instead of being caught in a negative loop, seeing bad returns, feeling terrible, and making rash decisions, you become someone who can calmly assess their situation, pinpoint root causes, and implement improvements. You gain confidence, you become more disciplined, and you make better moves. Over time, this can significantly enhance your returns, reduce stress, and help you live a more balanced life, both financially and emotionally. Let's look at three examples to really illustrate how these psychological and practical strategies can play out. Picture Daniel, a 35-year-old sales manager who invests regularly in the stock market. He checks his returns after 6 months and sees he's trailing the S&P 500 by a few percentage points. Frustration hits hard. He feels like a failure and starts considering dumping some of his well-researched holdings for whatever new hot stock he read about online. Then Daniel decides to use a psychological strategy, reframing expectations. Instead of expecting to beat the market every month or every quarter, he acknowledges that beating a broader index is challenging and typically requires a multi-year horizon. He shifts his time frame from months to years. Now, when he sees a dip, he doesn't panic. He recognizes investing as a marathon, not a sprint. This reframing eases his frustration, clears his head, and prevents rash decisions. Consider James, a 42-year-old project manager making a comfortable income, but too busy to follow stocks daily. He kept picking stocks on gut feelings and ends up repeatedly disappointed. He's frustrated that he's always behind the S&P 500. This time, instead of acting emotionally, James adopts a practical strategy, creating a quarterly portfolio review checklist. Every 3 months, he dedicates one Saturday morning to reviewing company fundamentals, assessing whether his investment align with his criteria, and comparing long-term performance. Having a system reduces a knee-jerk reactions. When frustration flares up, like discovering a stock he chose underperformed, he follows the checklist and makes methodical decisions rather than emotional ones. Over time, this systematic approach improves his choices and lowers his stress. Imagine Carlos, a 50-year-old engineer who's always busy and hates that he's not beating the S&P 500. Every time he sees red in his portfolio, he wants to click sell immediately. The frustration builds up and he's on the verge of giving up on individual stocks altogether. But Carlos tries a psychological strategy, mindfulness. Before making any trading decision, he takes a 5-minute break, breathes deeply, and notices his emotions. He acknowledges the frustration without judgment. This tiny pause helps him separate the feeling from the action. He still might sell, but now he does so after thinking clearly, not just reacting emotional. Over time, these mindful pauses help him hold onto quality stocks through short-term setbacks, ultimately improving his performance. In all three stories, the investors face frustration but handle it differently than before. The result? More informed decisions, reduced stress, and gradually improving returns. Now, let's address 3 common objections people may have about using psychological and practical strategies to deal with frustration. Objection 1. This sounds like therapy, not investing. I just want stock tips. While it might sound a bit psychological, managing emotions is a critical part of successful investing. The market is driven by people who buy and sell based on fear, greed, and expectations. If you ignore the psychological side, you'll fall into common trap. By addressing emotions, you're actually optimizing your decision making process. Think of it as upgrading your mental software. You're not giving up on strategy. You're making your strategies more effective by clearing emotional roadblocks. Objection 2. Don't have time for this. I barely have time to research stocks. These strategies don't have to eat up a lot of time. Small, consistent changes can make a big impact. For example, taking 2 minutes to reflect on your emotional state before making a trade costs you very little time, but can save you from catastrophic decisions. Setting up a simple quarterly review process might add a couple of hours per quarter. That's a negligible time investment compared to the countless hours of worrying and second guessing you might otherwise endure. Plus, the goal is to make you more efficient, not less. Projection 3. I've been frustrated before and tried to calm down, but it never improved my returns. Effective psychological and practical strategies are not about calming down once and then magically outperforming the market. They're about building habits and frameworks that consistently shape better decisions over time. It's like physical fitness. One workout doesn't fix your health, but a series of good habits over weeks, months, and years transform your fitness level. Similarly, repeatedly applying these strategies helps you steadily improve your decision making, leading to better returns in the long run. It's a marathon, not a sprint. Now, let's look at a wrong way to deal with the frustration of low stock returns and the consequences that might follow. Then contrast it with a right way to do it and the benefits you can reap. Imagine you hear about these psychological and practical strategies and you interpret them as simply thinking positive whenever you feel frustrated. So, the next time you see your portfolio trailing the index, you say to yourself, it's okay, I'm great, without actually examining why you are losing ground or what adjustments you can make. You force a fake smile, shrug off your genuine feelings, and continue making the same mistakes. Or maybe you spend hours each day obsessing over tiny emotional fluctuations without taking any real world action. This approach lacks honesty and balance. It either underplays the value of sincere emotional process, just slapping on a positive attitude, or leans too heavily on self analysis without converting insights into tangible improvements. When you handle it incorrectly, you don't solve the underlying issues. Your frustration remains and possibly worsens because nothing truly changes. In fact, you might become even more confused and stressed. Over time, this can lead to hasty decisions, chasing hot stocks due to impatience, or selling promising assets at the worst time. You might jump from strategy to strategy without a solid framework. Ultimately, you risk losing more money, feeling more discouraged, and reinforcing a negative cycle that's thought to break. The right way involves a balanced, honest, and systematic approach. First, you acknowledge frustration without judging yourself harshly. Understand that the feeling is natural and comes from unmet expectations. Then you apply a combination of psychological and practical strategies. For instance, you reflect on your long term investing goals. Remind yourself that performance should be measured over years, not weeks. And use a simple technique to record what triggered the frustration. Alongside this, you implement practical steps such as setting up a structured investment plan, diversifying your holdings, or refining your stock selection criteria. You don't just feel better, you do better. Maybe you decide you'll spend 1 hour a month reading a well regarded investment newsletter or research service, something that gives you quality insights without overwhelming you. Perhaps you automate part of your investing so you're not making emotional decisions. Over time, you see more consistent results, less stress, and gradually improvements in your portfolio's performance. You build confidence, discipline, and a sense of control, which can help you outperform the index in the long run. By properly applying these strategies, you create a positive feedback loop. Better emotional management leads to clear thinking, which leads to better investment decisions, which often leads to better performance. That improved performance reinforces your confidence, making it easier to continue applying these strategies. You gain the assurance that you're on the right path, even if progress is incremental. In other words, the right way creates a long term foundation for growth, both emotionally and financially. Now, I know you're busy. You have a demanding job, family responsibilities, and limited time. Let's cut to the chase. What's one small step you can take right now? Starting today, commit to a single practice: the 5-minute portfolio emotion check. Here's how it works. The next time you log in to see your portfolio, and you can do this the next time you're able, give yourself 5 minutes before making any change. In those 5 minutes, write down what you feel: frustrated, anxious, hopeful, scared. It might sound silly, but putting your emotions into words helps separate feeling from action. After that, if you still think you should make a change, consider one practical step. Check the fundamentals of the stock or review the last quarterly earnings. This tiny habit helps you slow down, acknowledge your frustration, and make decisions more thoughtfully. Over time, this small practice can significantly improve how you handle the stress of underperformance. If you found value in this discussion, hit the subscribe button and ring that notification bell. By doing so, you'll be the first to know when I share new strategies and tips on how to surpass the stock market. Remember, investing success isn't just about picking the right stocks. It's about building the right mindset and habits that lead to better decisions, less frustration, and steady improvement. Subscribe now and join me on this journey to outpace the S&P 500 and reach the peak that so few investors ever see. Your future self will thank you.